Good afternoon and welcome to this ACC webinar on reporting of derivative trades, the countdown to implementation. I'm Martin O'Donovan, Deputy Policy and Technical Director here at the ACT, and I'm delighted to welcome our two speakers. We have Barry King, Technical Specialist on OTC Derivatives at the Financial Conduct Authority, and he'll be reminding us about the core features of EMIR, and in particular how companies and the FCA will relate to each other in this new regulated world. We'll follow that with Danny Corrigan, CEO of CME European Trade Repository. He'll be explaining the reporting requirements under EMIR and the role of trade repositories. Importantly, get onto the detail about what companies need to do to get up and running on trade reporting. CME is one of the new breed of trade repositories, and it's expected to be authorized to collect and maintain data on derivatives. They've got a long experience of operating exchanges and clearing, and have already been operating a repository service in the US. They've sponsored this webinar, and I'd like to thank them for their involvement in this session. You may have seen a couple of weeks ago that ESMA registered 4 trade repositories, and CME was not among that batch. But rest assured, their application is going through, and we expect that they'll be registered very, very shortly. After the presentations, we'll take questions, which the three of us will try and answer, or at least debate if we don't know the answer. Everyone connected live to this webinar is able to send in questions by clicking the Ask a Question button, which you'll find just below your main media player window. There's no need to wait until the end to send in your questions. And you'll also see there's another button there if you need to ask for live event technical support. I should add that a recording of this webinar will be available on the ACT website in a couple of days' time. I suspect most of us are now familiar with the reasons for EMIR and the key initiatives that it takes in the areas of clearing, other risk mitigation such as confirmations and reconciliations, and on reporting. In this webinar, we'll be majoring on the reporting element. But first, can I turn to Barry King to run us through the wider aspects of EMIR in this new world where non-financial companies will, to some extent, come under the supervision of the FCA, which we normally think of as a financial regulator. And of course, this could be the first time that companies have had to think in these sort of terms. So, Barry.
Thank you very much, Martin. And hello, everyone. Thank you for joining us this afternoon. As Martin's just said, what I'd like to do in this short introduction is, first of all, just quickly summarize the timetable for implementation of EMIR and give everyone a reminder of what's coming next. Then I'll go on to talk a little bit about some of the main drivers for the reform and why we are putting in place all of these changes. And finally, I'll talk a bit about the FCA's role as the supervisor of the EMIR requirements in the UK and how we expect our supervision and enforcement of the EMIR requirements to work. So, first of all, a quick summary of the main points of the EMIR implementation timetable. We're now part of the way through the EMIR implementation. The first aspect of EMIR was the introduction of the timely confirmation requirements, starting off with longer confirmation times of up to a week on the 15th of March this year. But then, over the course of the next 6 to 12 months, those confirmation timelines will get progressively shorter for non-financial entities, moving eventually to a T+2 confirmation requirement. So that is quite a challenge, I think, as we come into 2014, and those timetables start to get a little shorter. Secondly, EMIR introduced a number of operational risk management requirements in relation to the derivative positions, not just of financial firms, but of non-financial corporate entities as well, in relation to the reconciliation of portfolio positions against other entities, the resolution procedures for disputes, and also the need to consider whether or not trades should be compressed. The level at which these requirements apply, the frequency, for example, of portfolio reconciliation, varies a lot depending on the size of the activities of each individual firm. But all of these things should act together to make sure that everyone has a better idea of the derivatives positions and exposures that you're facing each day and each month. And then we get to the current EMIR requirement, which is in everybody's minds, and will be the focus of the discussion today, the reporting of the details of derivative trades to these new trade repositories. CME will talk a lot more detail about this in the next part of this discussion. But from our perspective as the SCA, I just wanted to note here that this requirement will apply both to OTC derivative transactions and also to exchange-traded derivative transactions, all commencing on the 12th of February, and is, as I'm sure everyone's aware, different from the American requirements introduced through Dodd-Frank, because it will require reporting by both parties to a transaction. So that means non-financial entities will have to report those trades as well. And then later on, as we move through the EMIR implementation, we will see improvements in client position segregation where relevant. And for non-financials with a lot of non-hedging transactions, the clearing obligations and margin requirements. But I'm not going to focus on those today. Secondly, I said I would very briefly present the case for EMIR. I've put 4 bullets on the slide here. I just wanted to draw attention to the fact that the primary focus, of course, of EMIR is the OTC derivatives market. This is a market which, until EMIR was introduced, really hasn't been regulated in a very great detail. So for us, this is quite a significant expansion of financial services regulation. Our main aims in doing that are to reduce systemic risk in the market by introducing these operational risk management requirements around reconciliation of portfolios, confirmation of trades, and so on, to increase transparency and our ability to supervise the market through the implementation of the reporting to trade repositories. And also for those firms that face the clearing and margin requirements, to make sure that where we do see increased levels of trading, unlike we saw during the financial crisis, it is properly backed up with collateral and margin. I also just wanted to draw attention at the bottom of this second slide to the fact that in Europe, EMIR is the main piece of reform, but there will also be changes introduced through other pieces of legislation. One of the most relevant ones here to you may well be what we call MiFID II, but this will introduce, in around 2015-2016, a requirement to move some OTC derivative business onto exchange. And finally, from me, a little bit about the way in which the FCA intends to approach supervision and enforcement of EMIR. We are very conscious that EMIR has introduced a huge amount of change over a very short period of time in the derivatives market. But the changes that are being introduced are legal requirements within the UK and the rest of Europe. So it's very important that everybody involved in the derivatives market, whether a large bank or a small corporate firm entering into a few trades a year, knows what requirements they're subject to and is putting sufficient resource and planning into meeting the requirements as they come into force. As long as firms have done that, if there are areas where perhaps the plan wasn't able to completely meet the implementation date because, for example, not all of the information had come through from Europe, or the people that you're trading with perhaps weren't ready to provide all the information to you, then we at the FCA do understand that, and we'll still expect you to be putting resources and planning into meeting the requirements as soon as possible. But we have a statement on our website that explains that is as far as we think firms can be expected to go in order to meet the EMIR requirements. And I finally just wanted to draw attention on the last 2 bullet points on this slide to the fact that we are, during this implementation period, carrying out implementation reviews where we go and talk to a small sample of firms about the way in which they're implementing EMIR and we're going to publish the results of those reviews on our website so that we can help the industry and help non-financial entities get an idea of what everybody else is doing and try and encourage a bit of consistency in implementation. We've already done that for the clearing threshold, the determination of whether trades entered into are hedging or not, and that's available on our website. Early next year we'll be doing exactly the same thing for the reporting requirements as well, flagging good practice, flagging problems that exist, and making suggestions for how firms can comply with the requirements. Okay, I'm going to stop there and hand over to CME to cover a bit more of the detail around the reporting.
Hi, good afternoon. Thank you very much, Barry. Thank you, Martin. My name is Danny Corrigan. I'm the CEO of the CME European Trade Repository. And I'm just going to run through what is required, when it's required, and also, thirdly, how you can actually get to the reporting requirement date of the 12th of February in the best possible way. So just to put it in context, there could be up to 100,000 legal entities in Europe that have to report because the reporting requirement is so vast. And we've calculated there could be 5 million trades a day. Now, a lot of people are numbers dyslexic, but 100,000 legal entities, 5 million trades a day is industrial sized. The operation we're about to engage on is a little bit like developing the IT system for the National Health Service. It's large and it's complicated. However, a lot of resources have gone into it between be it banks, fund managers, corporates, and coming into the trade repositories. A lot's been done, and I just want to run through where we are and some pointers about what we should do next over the next 80 days before we go live. So first of all, what has to be reported, the reporting requirement in Europe is much wider than in the US because it covers more asset classes. It covers rates, credit, foreign exchange, commodities and equities, and it's over-the-counter and exchange-traded derivatives. So it's in the US, the range is smaller and does not include exchange-traded. The second issue is this, especially for corporates. In the US, there's exemptions, but here it's financials and non-financials. So financials and non-financials have to report all those products, over-the-counter, exchange-traded, and over-the-counter bilaterally settled as well. And there's something called dual reporting. In the US, there's a hierarchical reporting structure so that, for instance, a swap dealer will report on behalf of the counterparty. That doesn't exist here, although there are some suggestions to reduce that burden as we go through. That's known as dual reporting. So all those legal entities in Europe have to report all those transactions to a recognised trade repository. ESMA, the regulator, based in Paris, was set up 2 years ago and is approving licenses now. 4 have been approved, and we expect, along with one other party, to be approved next week. We've got form in this. We have an SDR in the States. We were one of the 3 to start there a year ago. And broadly, it's very, very similar. Obviously, the technology is similar. The burden isn't as large, but there's a lot of similarities. What has to be done? Well, transactions have to be reported by T+1, but it's end of day T+1. So on a Monday morning, if a trade is executed, it doesn't have to be reported to that trade repository till the end of day. And a little bit later on, I'll go through how you can actually send a report in. But it has to be done by the 12th of February next year. Now, there's been much talk about whether there's going to be a delay for some of the asset classes. Beyond that, and it looks very publicly like there is no delay. So 12th of February 2014 is the date on which the companies have to report. And very, very kindly pointed us there in a direction of what compliance may mean. I wouldn't mind talking that through a little bit further on, whether an LEI and a plan is sufficient, or whether the compliance officers of some firms will say they have to start reporting on that date. Right now, our reading is that all those legal entities will have to start reporting on the 12th of February. Now, what has to be reported? You've probably all heard about these infamous now 85 fields, which cover all the products. 26 of those fields are counterparty data, and that's, as it says on the slide there, participant IDs and valuations. And the balance 59 are common data. Now, not all of those have to be filled in for each product. And the good news is that many institutions, banks, clearinghouses, trade associations have got together to work out what ESMA means by these fields for different products. And it's generally accepted what this means for new transactions, for backloaded transactions, and for life cycle events as well. Now, what records must be kept is any derivatives up to 5 years following termination. And the last point here is the back reporting. That there is back reporting. This can be one of the biggest problems. What ESMA is looking for on behalf of the authorities is to have a stock of data from when it goes live, so something meaningful. So the date was picked from 16th of August 2012. It's all those transactions that are still outstanding when we go live, 12th of February next year. And then there's also a requirement for trades that were outstanding on that date, but not have been closed out before that. So, and there's a delay to that reporting. So you have a requirement to report stock up until the 12th of February, and then flow from there on. Okay, now, a lot of people have said to us, what do we need to do? The most important thing, I think, is to obtain a legal entity identifier. There's about 3 acronyms that keep coming up: LEI, UTI, and UPI. There are many more. I won't burden you with those, but the first thing is you have to set up as your legal entity as a legal entity identifier, and you apply to your local generator of that, although you can apply for one abroad. And in the UK, it's the London Stock Exchange, and I think it's something like £250 plus VAT, and then £200 a year. And then what you have, that's, if you will, that's like a lookup table. That will be your LEI for all transactions. All over Europe, in each individual country of the European Union, there's an institution being designated to do that as well. Last I heard on Monday was that less than 1,000 LEIs had been requested. So just like the clearing mandate in the States this year, where there was a mad rush to the end, it looks like the same would happen. I think a good Christmas present for any of your associated companies in your group would be to help them apply for an LEI. So that's the first thing. It's half the battle to start with that. Secondly, then, is to decide which transactions fall under EMIR reporting. Now, we've got a really good deck here, PowerPoint presentation, and all others, be they your bankers or other trade repositories, will tell you what they think it is. It's not as totally clear as you might think. And Barry's got, we know one of the questions coming a little bit later on, will cover the products that you're concerned with most. And we think those are foreign exchange swaps, foreign exchange forwards, interest rate swaps, and then the odd cross-currency swap. We will cover more, but those ones, I think, it's crucial that you get some idea of what's required and what's not. So, if you will, a second point, decide which transactions fall under EMIR reporting. Next thing is to speak with your counterparties to work out just how this is to be done, because each legal entity is required to do this. Now, it can discharge its responsibility by basically delegating that reporting to someone else who will do it on their behalf. Although, if they do it wrong, the comeback is still on that legal entity. So you may want to just report it yourself, and on a couple of slides later on we'll come on to how that works. And it is really quite straightforward to report into the CME Trade Repository and the others, more or less the same standard, a very broad range of messaging that would be familiar to yourselves. So you could do it yourself. You could, there's talk that some of your bankers may do it for you. I can tell you a lot of banks will not do it for other people because there's reputational risk. There's not quite sure there's a return in it, and they have enough trouble working out their own reporting themselves. Again, I would talk to them on that point. We've got up here back office providers. It's a terrible name, really. There are bureaus that will do this on your behalf, and they're well versed in it. And the crucial point is to take your transactions and to translate them so they're into something meaningful for the trade repository. Because we know that corporates and commercials and banks, asset managers, fund managers and so forth often report differently depending on whether they're coming off a mainframe or a spreadsheet or one of the systems. Then they do not look the same, that's for sure. And so whatever your trade is, you want to make sure that I think you want to feel sure that as you submit it, it gets translated so that it can be sent in to the trade repository and they can accept it. Because unless it comes in a format the trade repository can accept, it will bounce back. And the most important thing of that will be the LEI of yourself, the LEI of your counterparty, and what's called the UTI, something we'll come to a little bit later on, and that's the unique trade identifier. So the next thing is, so work out whether you're going to do it yourself. A lot of firms will do it themselves because actually it's not as cumbersome or onerous as first thought, but really the call is yours. So next point we said, understand different trade repositories offerings. To be honest, I think more or less they're the same. What trade repositories really do is they take in transactions, so long as they're in the right valid format, they'll take them in. And what they do with them then, essentially, is they do a form of reconciliation to make sure that the two sides are certainly paired on bare details and compared on some more. And then they compile reports of positions, trades, and an aggregation to be made available to the authorities, to an extensive list of authorities who have the right to look in there. Not all authorities can look at all transactions of all counterparties. We can come to that a little bit later on. So then I think the idea is once you've looked at the trade repositories to work out which ones, and you may want to report to more than one, depending on the product range that you're looking at, because this falls broadly into three areas. There's exchange-traded derivatives, there's over-the-counter essentially clear derivatives that look these days very much like exchange-traded derivatives, and then there's the other ones, including forward foreign exchange, FX swaps, currency options, and NDFs, which are over-the-counter. A lot of that is paper, and one or two of the trade repositories may specialize in that area. Then the next thing is to negotiate the user agreement, sign the user agreement, go into testing, and get ready to start reporting. I think most companies will be working on a project plan for this. It's straightforward enough. We're very happy at CME to talk it through with yourselves, and we know from the other trade repositories who we're working closely with to make sure there's commonality and purpose. There's certainly a commonality in purpose, but commonality here in terms of reporting, that the process will be similar to make it as easy as possible for you guys to report to us or to them. Now, the trade repositories are, they're each utilities. They didn't exist before the Pittsburgh meeting in 2009. Set up first in the US with 3 known as swap data repositories, 6 in Europe, and others opening all over the world. And what they're there for, of course, is to provide, what Barry was talking earlier on, is to provide a level of transparency. The reform process covered 3 things. First of all, was about trade reporting, so that the authorities could know just what was going on. Really could have been called trade and position reporting, because trade reporting comes in and they get the trade data and calculate positions. But that was the first thing, leading to central clearing of derivatives, and then a form of automated or electronic trading on exchanges. So in the US, it started in December 2012 for trade reporting, and is ending now with CEFs that you've probably heard about, and that will they're going live now and up to the first week of February. The process starts here in Europe with trade reporting in February, and then we'll follow with central clearing and automated trading after that. So the real reason was to set this up was for the authorities, so they'd be able to see what was going on, to see, if you will, and they put a paper out on this, the FSB put a paper out on this, to see where there was concentrations of risk and concentrations of transactions between certain kinds of counterparties. It also gives a good idea to the authorities to see which products should go to central clearing next. So assuming the data that comes in is good, it's calculated well by trade repositories, the authorities should have a better picture of where risks lie. That's the idea. But also yourselves, I think what we've worked out from the States as well, is that it's very good for companies to be able to see what's in there themselves and reconcile the data from those positions, and secondly, to see what's been alleged against you. And if you do look at what's going on in the States, it's enlightening, and I encourage you to have a look at the website. If you look at the CME website or our competitors, that's ICE and DTCC, especially in the UK afternoon, you'll see the transactions rolling in, because there the reporting requirement is much more real time. And trades get reported to trade repositories in the US before they get reported anywhere else. You have to send them in and get them an acknowledgement back before you can pass the information to the market. So it is the primary source of pricing. So it was set up really for the authorities, but I think it's very good use to yourselves. And so you'll probably get your £200 worth of value for setting up the LEI just from that alone. So it's access, it's storage, it's aggregation of positions and trades, and it's reporting out to the regulators. Coming up to the last couple of slides. There's something that you'll hear about. This is something about reporting. Do you do it yourself? Do you ask someone else to do it for you, and you hope they do it correctly? And these last two slides just give you an idea of whether you do direct reporting or you ask someone else to do it for you. Delegated reporting. Now, there's all these new expressions that we never had a year ago, but you've got delegated reporting, partial delegated reporting, and so forth. I'd recommend taking the easy route. If your counterparty or your clearinghouse is someone that's good at this and done it before, trustworthy, has the ability to report in an industrial fashion, and really doesn't mess up, if they'll do it for you for a stipend, and a lot of them I think will, that's a good recommendation. Having said that, because the reporting process has been simplified by the trade repositories, you might take it upon yourself to do this. Just as an aside, some of the bigger companies, where there's many intergroup country transactions, have decided to nominate one of those, the sort of group treasury, as it were, to do it on behalf of the associated companies. And that's been seen also in asset managers and hedge funds. And it makes a lot of sense, because then they have all the data within themselves. They're not passing it on to a third party, who until then only had partial data and had to have the lot. So it's really a choice to be made. You might want to, for instance, consider starting delegating some or all the reporting to one party, and then taking on that role a bit later on. Given, again, as I say, I think there's some real good information can come out of this. The last two slides there about direct reporting and delegated reporting, we could show you many, many more slides on this. Essentially, what it just says is that the transaction can be done by yourselves. You can use a third party, basically, to translate, cleanse the data and send it straight in, or you could send it straight in yourself by a CSV file or one of the other forms of reporting that we've got. And so long as we get all the common and counterparty data in a format agreed, RTR and the other trade repositories group will take it in. The ways to get it in, last point for me, the ways to get this in are everything you can ever imagine. So any of the technical routes, FixML, RMQ or HTTPS, or GUI upload, CSV submissions, the whole range we can take in. We do have a lot of our proprietary technology, something called Clearport API, which is run on FixML, which can do the same. But just as straightforward transactions, for instance, a CSV submission for some of the smaller corporates might make sense. As I finish up, we and the other trade repositories have everything lined up now, so you can get frequently asked questions, you can get a deck, you can get a user guide, you can get draft user agreements and start testing. Testing is going on right now. Early adopters are starting. As I said, less than 1,000 LEIs have been applied for, so that suggests there'll be a rush. I think, and we'll put this one back to Barry a bit later on, I think if you have an LEI and a plan, that's a great start. But what I would say is this, I'm not totally convinced that all compliance officers will say, report to their audit committees and to the board, that an LEI and a plan will be sufficient unless they get more guidance. ESMA, I think, has done a fabulous job to date, but we do really need a lot more information on the field, what to do about calculating positions, many, many, many technical points that has not come through yet, because, of course, they're a new regulator. They were undercapitalized and understaffed. They're not now. They're doing a great job, and we wait for guidance, which we think, latest rumour is 20th of December, which would be about right, wouldn't it, week before Christmas. But Barry would know a lot more about that. But we and the other trade repositories and the other clearing houses are very much looking forward to more information to pass it on to you.
Great. Thank you very much, Danny. What we'll do now is move on to questions. We've already had a fair number of questions come through, so thanks for those. Do keep sending them in. I can already see that we're probably going to have more questions than we can actually answer in the time allowed. What I will say is that on the ACT website, we do have a set of FAQ on EMIR, and what we'll do is look at the questions that have come in and supplement that FAQ with any new questions that we see if we don't manage to get your question answered. To get going, actually the very first question that came in, which is probably one for Barry, was asking about FX forwards, and this question which I have heard on many a time, namely, do they count as derivatives for EMIR purposes? So this is, are FX forwards in scope?
Thank you, Martin. I'll try and provide a concise answer to that question. So the first thing to keep in mind is that EMIR itself does not define derivatives. Derivatives are defined in a different piece of European legislation, referred to as MiFID, the Markets in Financial Instruments Directive. And the definition of FX forwards there allows scope for each country within Europe to decide whether or not FX forwards entered into for commercial purposes should fall within European regulation as a directive. Different countries in Europe have taken different approaches on whether or not they bring all FX forwards into regulation or allow this commercial purposes exemption. There are links on the SCA website to the guidance which is available to help firms determine whether or not the trades they're entering into are entered into for commercial purposes, and that should be the first place that any corporate firm goes to get some more information on this. It is very important to note, though, that some of these criteria can be a little unclear. Where there is uncertainty, firms should be assuming that their trades are in scope. And the other point I just wanted to mention is that we've had feedback from some firms saying, given that it's hard to make the determination, it would be easier if they could just report all of their FX forward transactions, but they're worried about bringing FX forwards entered into for commercial purposes into the wider scope of the EMIR requirements and other parts of European legislation. I can confirm that from an FCA perspective, we don't see that to be the case. So if firms find it easier to voluntarily report FX forwards entered into for commercial purposes, that is absolutely fine.
Thank you for explaining that. It is a frequently asked question. Actually, related to that, we've had another one about if FX forwards then are not reportable by the company, if they meet the requirements you just specified, what happens if your bank counterparty does report them? Because it thinks they're reportable.
Yes.
So you'll end up with a one-sided report.
Which is probably going to be the case in a lot of circumstances, because the bank won't be in a position to understand whether or not the trades you're entering into, you are entering into for commercial purposes or not. That is not a concern. Our perspective in the UK, we know that we're expecting to see a fair number of one-sided reports because of this situation, and it will be something which we will take into account when looking at the reports.
Great, thank you for that. There are also a few questions coming in around the LEI, the Legal Entity Identifier, and in particular how this relates on internal deals. So this is intra-group, intra-affiliate deals. Well, I can answer one bit of it myself, is that internal deals do count as derivatives and do fall within all the usual rules. The question I've got here is does each internal entity need its own LEI? So very straightforward, I hope.
So the answer to that, I confirm, is yes. The legal entity identifier is one per entity. So all of the entities in a group, even if they are only dealing with the group treasury, will have to get an LEI. Could I just take this opportunity, Martin, just to pick up on a point which Daniel raised, if you don't mind. The idea of the 12th of February date is that firms should have gone further than have just got an LEI and having a plan in place. All entities need to be in a position to meet the EMIR requirements by the 12th of February. And in our discussions, we understand that while that's a challenge, if it's sufficiently prioritised, that is something which can be achieved.
Fair enough. Again, still on the LEI, the questionnaire here has got an LEI from CICI Utility, which I think is the US entity. Is that usable for European purposes?
Yes. So the answer to that is yes. there is a global committee of the FSB which is going through approving the issuers so they can issue a globally recognisable number, and that entity has been approved. So yes.
Thank you. Turning now to valuations. There's a couple of questions about submitting valuation data. Now, actually, my understanding is that if you are an NFC minus, so you're not into the regime of clearing and whatnot, you don't need to report valuations, even though in the list of data fields there is a slot for valuations. I think I'm right on that, aren't I? Barry? Yeah?
Yes, that's absolutely correct. Non-financials below the threshold will not have to report the valuation. All they have to do is, by the day after the trade, report that the trade has happened.
But then there's also another question about, well, if I come up with a valuation that's different from my counterparty, presumably that's in the context of reconciliations.
Yes, there's an important distinction here between the requirement that applies to people above the clearing threshold or financial counterparties to report the valuation on a daily basis to the trade repository, and the reconciliation requirement, which might apply to a non-financial counterparty either on an annual or quarterly basis. The reconciliation requirement, the SCA's view, is that that does include a requirement to reconcile a valuation, but you can expect to see more from this from ESMA, the European authority, in the next few weeks, because we're currently discussing whether or not that should be the case.
Good. Thank you. Turning now to the UTI, I think we've already heard that there isn't as such a system for creating the UTI. So, if I'm a corporate and I've entered in a deal with my bank, where do I get this UTI from? Danny, is that something you can focus on?
Well, unlike the LEI, which would be like a glorious lookup table, this doesn't exist. And the UTI, for instance, would come from a clearinghouse if it's an exchange-traded derivative. It could come from a bank, but it's not clear yet where it's going to come from. There is talk that in the guidance that we're looking forward to that there'll be some kind of rule there to say where it's going to come from, but right now we know that, for instance, our clearinghouses have offered to provide a UTI for the transaction because they have it at the point of trade. The clearing members could do the same for their clients as well, and then there's changes in those UTIs. There's a trade UTI and a position UTI, but whether there'll be a central source and that changes, we don't know.
So I can add a little bit to that. We're currently in the European group looking at in the very final stages of looking at a proposal for the generation of UTIs. That should again be coming out in the next couple of weeks. We realise at the SCA that that's quite late in the day, and what I would certainly say is that it's likely the UTI will follow a hierarchical model of assignment. So as Danny's indicated, it's likely that as the buy-side firm, you'll probably be going to either your dealer or the clearinghouse or the exchange to get this UTI. So I'd suggest that everyone look to getting in touch with those parties to discuss the generation of the UTI.
So there will be some sort of guidance or advice or help around that UTI generation. It's not a sort of mandatory formulation, because presumably if you can come up with a way of generating a UTI that is genuinely unique, that will still be acceptable.
So ultimately, the standard which ESMA comes out with will be the standard which everyone is expected to use. However, if people are currently building their systems, and we realise that probably people are, because the 12th of February is not far away, as long as you're building your system to generate a number which would be unique between the two counterparties to the trade, whether they're intragroup or external, that will be okay to begin with, and you can move to the common model in a reasonable period of time.
You've just mentioned the intercompany or intragroup trades, and they will need a UTI as well. There's a question here about how does one generate a UTI for your own internal deals?
Again, that's okay, it's no problem at all. The common model that's being developed will ultimately apply to the generation of a UTI between two group entities, but right now what I would suggest is people who are planning and getting ready for February the 12th, you just need to make sure, and what we really need is a unique numerical identifier that is unique between two counterparties. As long as you do that, then you've met a lot of what we're looking for.
Excellent. Now, another question here. This one is, if I paraphrase it, really getting to the purpose of some of this reporting, because effectively it's saying if a company reports a transaction, which is a hedge, it could be quite a big transaction, and it will appear then within the data repository that they have this huge position, which might, in some sense, look systemically dangerous. Are they going to get questions coming back saying, what is this? Or, in other words, the regulators using that data don't know that there's a compensating hedge.
So from our perspective, obviously we will be looking at the trade repository data, and it is quite possible that we'll identify some trades we're interested in, which probably in most cases are perfectly legitimate trades. And we certainly won't be taking any action without discussing first the background to those trades with the entities concerned.
Okay, thank you. I'm just searching now for a further question. On some transactions, we could end up reporting, again, one-sided because the other party is not in the EU and they're not reporting. Presumably that is something, again, that the TR will live with.
Sure, we're expecting that. It might be that they're not in the EU, or they're exempt, for instance, because they're a central bank, or it's with an individual. But there are codes for that. I think it's IENO, is it?
Great, thank you. I think now I'm just searching for a further question. I think we will just recap on one which I think Barry has already touched on, but we're getting quite a lot of questions around compliance and the attitude. But I think you have, to an extent, answered that already, so that if people are well on the way to compliance, putting words in your mouth, would you be relatively lenient?
So thank you for the opportunity to discuss this a bit more. It's a question we get asked an awful lot. From our point of view, we have limited flexibility here. So the 12th of February reporting requirement is a legal requirement. We are legally required to supervise and enforce that requirement. We don't have any scope to increase the length of time or anything like that. And so it is absolutely critical that everyone who is subject to this reporting requirement has a plan in place to achieve compliance with the reporting requirement by February the 12th. And we're quite conscious that that is likely to involve having to get, in many cases, for non-financial firms, external resource to work on this. But that's what people are going to have to do, because it absolutely has to be met. If, despite doing all of that, firms still haven't been able to get into compliance in a particular area, for a particular asset class or particular field, then we'd expect them to come to us, and we can have a discussion about what they're going to do in order to get into compliance as soon as possible. That's the sort of conversation we'd have in the normal course of supervision of any firm that we regulate. But it absolutely will not be acceptable for firms to have not made efforts which they expected to get them into compliance by February the 12th.
Okay, and I think we've probably got time for one quick one here, which is, if my bank counterparty is using a particular trade repository, is there in any sense a requirement on me to, if I'm doing my own reporting, to report via the same trade repository?
The answer is no. There will be 6 trade repositories, and what can happen is, in a one-trade world, the corporate could report one side directly to one trade repository, and the other side of the trade could report to another. The trade repositories are meeting to try and work out a way of pairing those trades. So, if you will, there would be that the other side of that trade could be in any one of the other 5 trade repositories. A system's been set up of public and private files to allow the trade repositories got one side of the trade to go looking for the other one. So long as the trades come in and it's got some decent detail on there, the minimum being the UTI and the 2 LEIs, and probably one other field like buy or sell, So long as it's got that and then more data to be matched a little bit later on, so to be able to pair, then compare, that'll work. Otherwise, it'll get sent back.
Right. Our time is ticking by, so I think it's now time for us to bring things to a conclusion. Thank you very much to our two speakers for dealing with those questions, and if I could also thank CME in particular for their involvement and sponsorship of this session. Thank you too for everyone who submitted a question. As expected, we have had more questions than we can deal with, so we will try and get some answers to those up on our website if you give us a short while to work through them. We will be putting a recording of this webinar up on the website. It'll be in a couple of days' time, and we'll be sending you a link to that, sending you an email with that link, and we can also provide you with the link to the FAQ at the same time. Going forward, if you do have further questions, do bear in mind you can post questions on on anything actually, including EMIR reporting, on LinkedIn, on the Association of Corporate Treasurers group. Do have a look at that and look at the current discussions and add your own comments and feedback if you have any. Finally, could I remind you to look out for further webinars coming from the ACT. We have one on the 10th of December, which will be on the topic of evolving bank regulations and their impact on the European debt markets. Details of that will be publicised before too long. So, thank you one and all, and I wish you all good luck with your implementation plans. Thank you.